world does business. Thank you all for joining us. Over to you, Mr. Amit.
Good afternoon, everybody. We have been told to be crisp and sharp and to the point. I believe all the speakers, especially from the legal world, are supposed to be very, very sharp. I will just start with small parallel track. Today we are going to discuss about mobilizing finance for responsible investing. And I believe everybody who is present over here is an investor in Indian stock market, in one way or another, either direct stocks or mutual funds and so on. And if you recently have followed the stock market in India, FDIs and FIIs have been going away from the stock market. Despite having a clear, stable political mandate in India, 7% real GDP growth, inflation is as low as 3.7% recently. I couldn't have asked for a better scenario with what is happening in our neighbors, what is happening in Russia, what's happening in Europe. I couldn't find a better and stable country to invest. So while the Indian investors like us who are sitting here and keep investing in SIPs, foreign investors are not coming to India. Either they are investing in US safe treasuries or they are looking for other investors outside. So my question and my theme for today's discussion is going to be, yes, we have SBIs and commercial banks, PFCs and RSCs who are providing enough INR in India. But what about the dollars? What about the Blackstones and BlackRocks who have the $1 trillion? Well, we do have offices of ADIA and others in India, but in terms of their investment, especially in responsible investing, is in single digit. And India, as we know, requires $1 trillion. We do not require $1 billion. And currently at this growth rate and how much energy, transport, consumption we are having, we do not have external funds. If anybody sitting here thinks that the Indian funds are enough to make us a developed country by 2047, we are not living in a reality. So first I will request my colleague Shalp from IFC, who actually has been doing a record business for the last couple of years, 2 billion and with a leveraging of $5 billion. Shalp, how would you comment on bringing foreign investment to India?
So first let's take a step back and see what does an investor want, whether it's for climate or renewable or whatever funding. What does an international investor, or for that matter, any investor want? Fundamentals have not changed. They want a risk return adjusted. They want a return which is adjusted with the risk. So compared to a domestic investor, which looks at a project risk and sees whether the returns are adequate or not, an international investor has to deal with two additional risks. One is the currency risk, which you layer on top of the project risk. And the second is the macro risk. They are sitting pretty in Canada or Netherlands or Dutch or wherever these pension funds or insurance companies or fund managers are. For them, they have to look at the geopolitical risk, the macro risk, the political risk, what can change in the landscape, and therefore, taking these two additional risks into account, they want a return which is commensurate with the risk. Now, you may argue, India is not a banana republic, so the political risk should be low, etc. But look at it from the eyes of a developed world. For them, it is an additional risk no matter how we slice it. And therefore, the challenge becomes how do we attract them? There have been pockets of success there, and IFC is consciously working to attract new and more diversified international investor base into the pools, whether it is infrastructure. We have done financing with platforms like Energrid, which is Blackstone, and we are working with Carlyle. We're working with many others on the climate space, etc. The second thing is, in order to attract them, we have started an initiative which is on what does an institutional investor want? They also want scale. They would not come in into small project here, small project there, and also. They want scale, which an international investor also wants and a domestic also wants. They want liquidity, which means there has to be a clear exit once they come in, whether it is through capital markets development, stock market, or strategic sale, or a secondary market, they want an exit. They would prefer some form of standardization. And standardization can take various forms, and Vivek is here from climate policy, and he can comment more on the policy aspect. At the end of the day, they want a policy certainty. They are going to invest in infrastructure assets or assets with long paybacks. they do not want political surprises on the way. So that is meant by political certainty and standardization. So we are working on all these three legs: scale, standardization, and liquidity. Liquidity is also hard. So what we are trying to do now is, although we have invested in a number of VC funds and PE funds in India, we are seeing demand to invest in secondary funds. Secondary funds are those funds who buy investments from other funds. And that will create a vibrant liquidity in the market. There is also something called originate to distribute. That's an initiative we are working on, where IFC would come in, take early risk in a project. Once it's fully structured, once it's operational and the risks are reduced, we pool a number of assets, standardize it, what we call securitization, and then market it. That's not yet done. It's work in progress. It's done here and there, but not done in a very large scale. That's something we are working on, and we would love to engage with many investors on that. Thanks.
Shalv, you highlighted 3S: standardization, securitization, and the other S was scale. I'm going to ask Upasana the next question on this, because Shalv mentioned very few interesting points. First, he said currency depreciation. Now, if you observe the dollar and INR, every year INR depreciates by 3%, but last year it was appreciated by 6 to 7%. Today it is 91, mostly because of the US-India trade dispute what is going on. So, if I'm a dollar investor, as Shalv mentioned, if I'm investing in India, I have by default a 3% negative return because of this depreciation of the Indian rupee. Secondly, he mentioned about standardization. Now, I know Trilegal and Upasana did a great work in Rewa Solar Park, where they built this 3-tier risk mitigation framework of having an escrow account with IREDA, a funded escrow account with IREDA, and they also brought in the guarantees from the state government, which was unheard of 10 years back when Rewa Solar Park happened at the state level. And securitization, as also mentioned by Shalv, for example, in the SBI mega deal, we were able to securitize the asset by bringing commercial finance from London. My question, Upasana, to you is that we have the scale, what Shalv was mentioning, which pension funds want. We can create $1 billion assets. We have the macroeconomic issues settled over here. But the work, for example, which Trilegal did in Rewa Solar Park, why we have not been able to scale up that work in all the 27 and 28 states in India and bring bankable projects like the Rewa Solar Park on a level where institutional investors will be ready?
Yeah, an interesting question. I cannot comment on the economics part of it, but from a legal regulatory point of view, I'm glad that you mentioned that project. And I think what I want to highlight from that is where there is policy intervention, definitely that has really helped scale up greater access to capital. So renewable energy is one example where, through efforts from various stakeholders, including government and states, right, there is much more access to capital compared to many other sustainability sectors. And there are playbooks which can be followed and replicated in many other projects, right? And of course, I think one of the reasons where people do get stuck is in the operational aspects and the dependency on, components from other countries. And there again, the policy intervention is helping where, there are PLI schemes to help be more independent and manufacture internally. It is a sector where it has become much more cost competitive, so therefore greater adoption. And of course, the targets that India has set for itself for net zero and climate change, that is so high that it's not possible to meet only through solar, right? So there needs to be a combination of efforts, and that's where I think we need to look to other things as well, and there needs to be innovation and technology that is to be used. And when it comes to innovation and technology, I think that brings another challenge, which is that it is not necessarily possible to standardize, right? And so there is an element of risk, and traditional capital will not follow risk So we need to find solutions to de-risk traditional capital providers, and I think for that, we are working with government and we are working with different stakeholders on trying to create a framework